My name's Marc Lehman, and I set up a company called Saasu about nearly 15 years ago now, when I was working in banking. And so I've been involved in the Genesis program for a few years now, just giving startups a bit of an idea as to what happens in a business like ours and other businesses I'm involved with, around what it looks like at the start and how to kind of grow the business and sort of fight the battles of finding money and dealing with multiple founders and all the problems that come up. But looking at that not just from just a general way, but also what financial models can you use to solve some of these problems? Because that's where all the uncertainty comes about. It's not having the data or the way of modelling things to remove the fear and uncertainty that is a big problem for startups. So I wanted to talk about that topic, give you some really practical stuff you can use straight away. So the startup dream. This is the most important slide of the presentation, and that's because everyone is really excited at the start with a startup, and it's super exciting because you've got this huge possibility out in front of you. And what happens is you will start to hit things that feel like roadblocks or problems or lack of money, and it'll suck the energy out of it, and you may lose the passion for it. So what I wanted to say is, don't feel that that you're not actually in control of that. You can take actions with simple modelling techniques and decisions about what you really want out of the business, and having a different perspective on what you're doing in your startup to avoid getting into that situation. How to handle initial equity stage. Now this one's really important. Everyone gets into a problem with this, in my view. You saw what happened, if you saw the Facebook move, you saw the drama that caused, not getting initial equity locked down properly. And we have thousands of startups on our product, and I've met lots of the young startups because as part of our Futures program we do things like this and we meet startups all the time. And it's a really common thing. They didn't get the equity right at the start, and you get what's called a greedy bone effect. So the greedy bone effect is, it's all cool at the start when there's no value, but you get 6 months down the track and the business is starting to get some traction and some success, and all of a sudden one guy's going, hang on, why did I say 20%? You know, the other guy's got 80% and I'm doing all the work, and you're just getting this full-on resentment, and before you know, the thing's busted up and it's all over. So you want to try and avoid that if you can. So the way, I'm going to give you the way to do that. This is one way. I'm sure a guy from Harvard will give you another way, and a guy from Sydney Uni will give you another way. This is my way. I'm not a finance dude, even though I spent my whole life in finance. So this is the experience of equity splitting. It's unfair, it's incomplete, it's unstructured, there's legal paperwork, there's changed contributions over time, people put in different levels of work into the venture, and unaccounted for contributions. So you might leave your job and work in the business, but you don't change the amount of equity you got in the business with your partner. And it's unfair, and you can get resentment and all kinds of stuff comes up. So what that looks like is people come to the conclusion that this is what an equity split situation is in a business. It's basically work out who's putting in the ideas, who's putting in the time, and who's putting in the cash. And you'll absolutely get the wrong answer if you use this method, but absolutely 95% of people use this method. So that's why most equity splits are incorrect in my view, or aren't as accurate as they could be. It's impossible to get it completely accurate, to be honest, but you can get it close, get to a reasonable level where reasonable people will stay in partnership in an investor group or a syndicate, or even if it's just two founders, without getting in a whole lot of fights, legal or otherwise. So people tend to do it on the back of a napkin. They've got their ideas, and classic thing is cafe, napkin, domain names, how much money each person's putting in. They start working out a few things some people have put into the business idea. Oh, it's my idea, so I should get more for that. All this kind of stuff comes up, and you might get an answer, but it's pretty much a hack job to getting an answer as to how you split your equity. Now, even if you're going to do this by yourself, this stuff is really important because you're going to end up getting an investor at some stage, unless you're planning to do a completely organic approach. You're going to own 100%, never give any to your staff, never invite any other investors, all the way to the end and exit, which just never happens. So good luck with that. You might know the big business that doesn't list. Like, there's people that have done that, to be honest, to be fair. and are very successful and never sold their businesses. So I shouldn't say that. There's definitely situations. And actually, if you want a stress-free lifestyle, that might be a better way. So, do some stuff on the napkin first to get the thought process going, but you've really got to switch into logic and maths. And the only way to do that is to start dissecting what it is that makes up the equity value of a business and having a Spock-like approach to it. And I think I like this because I like Star Trek. I'm not a Trekkie at all, but I like the whole space thing. But a very logical person, probably a product guy and thinker, sales guy, strategist. And that's a classic startup, 2 founders, 1 product, 1 sales. So you end up in that sort of scenario. So what you've got to do is look at there's probably 10 things to think about that make up equity value at the start and down the track too, in terms of the people you're bringing in and what you should give them. Say you meet someone who's really good, had lots of successes with startups, you're sitting there with your other founder saying, what are we going to give this guy for equity, what's he worth? That's a really hard question to answer, but there's actually an easy way to work it out. I'll show you in a second. So value execution and focus skills much more than ideas. That's the first thing to do. Everyone goes straight to the ideas are worth the money, but I guarantee someone else has thought it up or come up with some variation of that idea, and it's not as valuable as people think. And actually, the idea can get you in a lot of trouble, because if you claim the idea is worth all the money and someone already has a patent on it and you go and build out that idea, it's actually a liability to the business because you've built something someone else has already owned, and all of a sudden, actually, the guy that owns all the equity has got the idea that you're in court about. So you can't really look at ideas as a value in an outright sense. It's okay to attribute value to it, but I just think execution is way more important. Actually, winning at the game of the startup is much more about getting stuff done. The officer at risk. Now, what this means is that the way we have our society set up is that there is someone who's a risk taker in a legal and tax and privacy, and there's a whole pile of stuff. Someone's taking that risk, and you can have all the founders be directors and share the risk equally, or you might have a senior founder or who owns 80 or 90% of the company and you agree that that person's going to be the director and the public officer. You've got to attribute some value to that, and they should get some equity for taking on that risk, because it's hard dollars. If you think about it, there's no way I would go and be the public officer of a company, i.e. I'm the guy the ATO comes after, blah, blah, blah. There's no way I'd take that risk on, not knowing I'm not getting some reward back for that. It'd just be insane. Plenty of small startups do this. There's one guy taking all the risk, is a director, public officer, company secretary, you name it. They've got 50-50 shares. The other guy is so much safer, and it's a crazy situation to be in. So you've got to also present value your future time and cash flows. So what this means is if you've committed, one founder might commit to 2 years of working for nothing because they've been in a job and they've got some savings and they've paid off their house. The other founder might be a younger person, hasn't done any of that, can only afford to really do this for 6 months, and then it's got to start paying that person. The person that's giving up the 2 years has to be given some valuation for that in the equity split. And think of it also too, like it's different earning 200,000 and missing out on that because you go into a startup over 2 years. Say it's 100 grand a year or 50 grand a year. It's very different missing out on that to saving up that amount of money. So people make that mistake too. People will say, oh, I'm not going to earn my 50 grand a year for the next 2 years, so I'm putting 100 grand in the business. No, because to put 100 grand in the business and save 100 grand, you've probably got to work $500,000 or $800,000 of value to get that. So you've got to kind of allow for that. So that's the foregone salary opportunity cost, essentially. So the thing to do too at the start of the process is benchmark your ideas versus competitors' IP value. So that's about being realistic about what your IP is worth. Everyone pretty much thinks it's worth more than it really is, because their mind will find ways to say why it's special or different because they're in a state of excitement around the idea, which is fair enough, but you've got to be realistic about it and go, okay, another competitor's product idea is not as good, mine's up here, but the reality is, for them to get from here to here with a running business and everything and the machine going is probably not a lot of money. So you don't want, the difference there is actually really the IP value. It's not, the difference for that competitor to get to there is really the IP value. It's not, you can't just look at this in its outright sense. So think of it like, another good example is people, classic mistake people make around the stock market is that they say stuff like, oh, the stock market's going to sell off because there's huge inflation and it's going to crash. And so people get really fearful about stock markets, but what they don't realise is stock markets often rally really hard in inflationary environments, because when you benchmark the value of your business against another business and its R&D and its assets and so on, the opportunity cost of starting a business from scratch and buying all the stuff at high inflation prices to start that business has to be at parity to the business that's listed and trading. So you have to look at them in a similar way. And IP is the same. If I'm to go and create that IP in a high inflation environment and it's expensive to do, like IT people might cost 200 grand, a really good person, not 100 grand. The business that's listed has gone up in value by that amount, because to redo that has now cost 200 grand. So inflation is your friend in IP, and worth thinking about. Relationships and health preconditions. This one is nearly always forgotten about. Say a marriage in a dangerous situation can be just a problem waiting to explode if you're in a two founders or a group of investors, because all of a sudden people split up, they've got to sell their shares. That means it gets a bit public, you're getting out of the company. Stuff can happen, it gets a bit messy. Someone dies because they've got bad health and they've had heart problems, and all of a sudden you're in partner with their partner who you may not want to be in partnership with. So you've got to kind of think of that and look at each person and say, okay, we're all healthy, is there a good chance we're going to be okay? You never know. Has anyone got a divorce they haven't mentioned coming up? You know, all that kind of stuff. I know it sounds a bit stupid, but you'd be amazed how many people go into big financial decisions without having talked about that stuff. Also, that the partner of people is happy with the other person not working for a year or two and being involved in a startup, and the lifestyle change around that. There's often resentment there, and that hasn't been talked about in the group. So personal brand wash applied to business. So you have a personal brand, like the cheap and nasty way to describe it is how many Facebook likes you've got, but it's not true. Or you know, your presence in an industry or in a social or a networking sense. Just your contact network in general, stuff like that creates a personal brand. Some people can bring really massive personal brand into a business, and that's worth money, and they should get equity for that. And it's often a case one founder gets a bit of resentment towards the other founder around that issue, but you've got to recognise it. Like, people build up personal brand through effort. It just doesn't happen accidentally unless you're a movie star. But it's real and worth money. So you've got to kind of agree a probability of cash flows on things. So a good example here is you get a founder who's wealthy and the other one isn't, and the founder says, look, if things are going bad in a year's time, I'm going to put an extra 50 or 100 grand into the business and we'll keep it going and we'll be okay, like a promise. Now, that person's promise is probably pretty good. If they've got 100 million bucks in the bank and they've got a whole lot of properties and they're trustworthy, that's great. But if that person's got $1 million mortgage, the market's about to collapse, that's not worth the same amount of money as $100,000. So you need to look at it from a risky perspective. So promises made about money coming into the business down the track, or people bringing in investors when we get to a certain size, all those promises need to be discounted a bit. So applying some probability of those things happening when you're working out the equity split is really important. Now, I'm going to show you in a second how to do this anyway, so don't, if you're wondering what is the calculation for that, don't worry about it, I'll show you in a second. Valuing experience and youth. So experience is excellent, obviously, because you've learnt from a lot of failure. You've probably worked out how to be pretty efficient in terms of getting stuff done. But you may not be willing to work 18 hours a day. So there's pros and cons of each, and youth, same thing. Doesn't have rituals and habits in place that are bad habits, so it's thinking outside the box. There's benefits around that. But there's always like a flip side to it. So, you know, a youthful person might be more of an explorer and less of an action-orientated person, or I'm just making generalisations. But what I'm saying is don't just bucket people into young versus old as good and bad, because it doesn't work that way. So the real starting point for the equity split part of a startup in terms of modelling it is to actually look at it in a bit more detail. So ideas do have value and IP has value. We've talked about execution as being really important as part of that. There is capital going into the business, be it physical capital or cash capital. There's costs that have already happened, like people forget about that one. Someone could have been working on a project for a while and might have been paying web hosting bills and might have been buying wood to make their chairs that they're going to sell online or whatever it is they're doing. There's risk taking that's worth money in the split, and there's the brand that you bring into the business. So you might bring brand in a personal brand sense, but you might also bring in brand in your concepts and ideas. And I saw that with one startup in a customer of ours who, the guy came from he was head of digital marketing at Saasu. He was a really smart guy in terms of understanding data and brand, and he created an amazing brand and just came into the business with another founder with that as very high value, I thought, because he'd nailed it straight away from his background. And that's worth money, because that company didn't have to go off and spend 200 grand with Saasu to get it. So you kind of got to value that stuff as well. So this is one way you can do this. So don't treat it as gospel, but I think it works well to get a more accurate method than the napkin. There's other models you can use, but the thing is to look at the initial capital breakdown first. What stuff has each founder? Just imagine this is a spreadsheet with lots of columns for the different initial investors and founders. What money has been spent in different areas to start off with? So there's, cash might be put into the bank account to start the company. Someone might have spent some money on some website development already with a friend or something and got some business cards printed. The other founder came in a bit later, so hadn't done any of that. Just list down all the stuff that has been spent to date and you'll get a number. And so this person has spent 38 grand to date, cash in the savings account for the business, all the other stuff, 38 grand. This person's put in 11 grand so far. So put some money in, it's coming into the business late, got $1,000 of miscellaneous stuff that relates to getting this happening, maybe some legal fees for a shareholders agreement between these two. And you're starting to get the first number you need in terms of the initial investment split. But it's only the first bit. So that's one line. Think of that as one model, what I just did, in a proper model where you're splitting startup equity. If you really believe you're going to do this for lots of money, you want to go through this process. And you can do it in one spreadsheet, but that's one part of initial capital, and I've transposed those numbers up into there, 38 grand and 11 grand. Then you start going through different areas, like contracted future capital. That one is for example, one founder says, I'm putting 150 grand in a year's time, and the other founder says, okay, in a year's time I'll put another 100 grand in, and they agree that up front. Opportunity costs. So one founder's left a job for 2 years at 75 grand a year, the other one's left a job for 2 years at 50 grand a year. So there's 150 and 100 grand split there. If you wanted to be, obviously, I'm not discounting this or present valuing it, but if you want to be really accurate, you could start doing that because that cash flows in the future. So if you're a finance background, you know what I'm talking about. Money in the future is worth less today. So 100 grand in the future is probably, 90 grand, roughly 90 grand today if it's a 4% interest rate, 5% interest rate. So you start working through this and you'll start to see some stuff that I've talked about earlier. Being the public officer, facing the ATO, okay, 50 grand risk there. I'll take that on, happy to do that job, but I want some value for it. Because if I'm to go out and do that as a CFO in a company, I'm going to get 150 grand because I'm taking that risk. And 50 grand of that 150 grand is for taking that risk. So it's real. Company secretary role, debt provision. So things like debt guarantees. One director might write the guarantee on the lease for the property, for example. That's a $40,000 investment that's just capital sitting aside. Now, I haven't got that right because you get that money back in the future. So it should be the difference between, it should be the interest value. Taking on the director role, that's risky too. That's the asset-facing risk you take. Non-financial resources, if one person put in computers and desks and stuff like that. Free resources acquired. Maybe this founder got his wife to agree to help for a year and she's a sales exec and she's coming into the business and she's just going to help out for a year because they've got some savings behind them. So it could be something like that. So while she's not getting paid, it's worth money, so it should go in here. And so eventually you get through this list and you look at stuff like pre-existing IP, key relationships. So if someone had a relationship with, say, Richard Branson and could really call on that guy to do something, I mean, that's got to be worth some money. So it's hard to put a value on that stuff, but you kind of almost notionally want to do that. To be honest, that one's really tough to put a number in there. It is a guess. There's no right or wrong about that one. Business and strategic planning. Someone might be financially savvy and the other person might be sales and marketing orientated. But if that person's financially savvy, has a banking or finance background, saves you going to an accounting firm to do that. That's a 15 grand bill, so it's worth some money. So you get like a day one intrinsic value, and then you can work out your equity split pretty well from that. This is a good way to do it, and you can do it across multiple founders. It's one model. There's other models, but we don't really have time to go through them all tonight. As companies doing bigger startup projects that are putting millions of dollars of capital in right from the word dot, they'll have a project sort of spreadsheet modelling system that looks at present valuing all these cash flows and putting risks against them and looking at IP in a more valued sense by getting accountants to work out what IP's worth and goodwill or anything that's coming into the business before they split it. But that's for like really big startups that are backed by players looking to move companies from initial values of millions to hundreds or millions or billions of dollars.